everyone. On behalf of the partners and staff, we welcome you to this morning's financial reporting session. This morning we have two guest speakers. First, we have Carmen Ridley, a current member of the Australian Accounting Standards Board. Carmen will give us an update on the likely future of special purpose financial reports and also an update on the new revenue, lease and financial instruments standard. Following Carmen, Joel Dare, tax consulting HLB partner, will give us an update on new tax changes that are affecting your businesses in 2018. And I hope you enjoy this morning's session.
Thanks, James, and welcome everyone. Just to reiterate, please ask questions throughout. I know that there's a number of you in the audience who could be thinking, surely she's not talking revenue, leases, financial instruments again. We've heard her talk on this so many times. I am going to talk about them, but I'm not going to go into the detail. It's more just a reminder of lots of things. We are seeing so many entities who are so unprepared for this. So the more reiteration I can tell you about these changes, I'm also going to talk about transition and your transition options around that. The first thing I'm going to talk about is special purpose financial statements. So hopefully we'll get some interaction and some feedback. This is a really live topic. I'm really interested to hear your thoughts on it. So I guess just to give you a bit of background, special purpose financial statements, the way that we use them in Australia, we are the only country in the world that allows entities to self-assess the content of their financial statements. So we've been looking at it as a board for a while. Way before I was on the board, it's been talked about. It's this strange concept where you have to consider, is it reasonable to expect the existence of users? And would those users rely on your general purpose financials? I want to know, this is the rule and this is how I follow it. So reasonable to expect the existence of users. I don't know what that means. How do I know whether it's reasonable to expect? And there's lots of discussions. I've had lots of discussions with audit partners. I've had lots of discussions with CFOs, with directors around that. We did some research, or the board did some research back in 2010 that was about proposing getting rid of special purpose accounts. And they proposed getting rid of them at that time. A lot of the feedback came back and said, you don't have evidence that the reporting entity concept is not working. So some academics were engaged, there was interrogation of ASIC databases. It's been on our agenda to do something about it. We just have had some other priorities. So why now am I saying that special purpose and calling it the end of special purpose? We've actually had something that's happened which has really accelerated our time frame. And that is that the International Board has released a new conceptual framework. Now, I'm not going to ask how many of you in the room have read the conceptual framework, the old one, because I think the numbers would be very minimal. What's the purpose of the conceptual framework? It's effectively our umbrella. It is the guidance that overall we prepare financial statements under. So it gives us the definition of income, expenses, assets, liabilities. It gives us our fundamental concepts. So reliability, faithful representation. It's what we use as standard setters to write standards to make sure we're all operating under that same basis. The International Board has been revising their conceptual framework for a number of years, and we finally, in March 2018, got their updated version. Now that contains a definition of reporting entity that conflicts with our Australian definition. So their definition of reporting entity is more about the boundary. And what I mean by that is, should you be preparing single entity accounts? Should you be preparing consolidated accounts? Who do you actually bring in to your general purpose financials? Whereas our reporting entity definition is all about what type of entity are you, and therefore what type of financial statements can you bring in. So there is an absolute conflict between these two definitions. And the reporting entity concept in the international framework is referred to throughout that framework. So hence we've had to look and say, okay, we've got a conflict of definition. Is this now the time to actually revisit and say, do we need special purpose financial statements? Is it a concept that we need to get rid of within Australia? We have had comments such as, well, just come up with a different name for it and therefore just call it something different in Australia. And we considered that, but we believe there's actually some issues. We don't think it's as simple as let's just change the name and carry on going as we are. So we have this new framework. We have a directive from the Financial Reporting Council that says that we have to have IFRS compliance within Australia. And that is mainly for our listed entities. So they need access to global capital markets. It's really important that an overseas investor can look at a set of Australian company accounts and say they comply with IFRS. We understand these standards, we understand how the numbers are being put together, and therefore it is a potential that we can invest in this entity. So IFRS compliance at this point in time is not up for discussion. We have to have IFRS compliance. Hence we have to release the conceptual framework to allow our listeds, other publicly accountable entities, and anyone else who chooses IFRS compliance to be able to retain that. So what we're looking at is to say, okay, well, we know we've got to release the framework, we know we've got a conflict for certain entities, so therefore what do we do from that? We've also considered these two problems that we believe exist in Australia, and these are all referred to in a consultation paper. We believe that we have this conflict of reporting entity concept, so we have to deal with that. But instead of just changing the name, as I said, we do believe that it's an issue in the fact that we allow entities to choose what they put in their financial statements. So if I describe it in respect of, you know what, if you guys decide that you're not a reporting entity, that there's nobody out there who's going to look at your financials, you can pick and choose which standards you comply with. And if you say it like that, that's really quite phenomenal. We have entities who are lodging accounts, we have entities who are giving out financial statements, and there's massive inconsistency because some entities will choose to comply with certain standards, others won't. I reckon at least once a week I get a call from one of my clients that says, we've got a client and they don't want to comply with this particular standard, can we just not comply with it? And my answer is, technically you can because of this ridiculous reporting entity concept. However, does that make sense? Is it giving the right answer? Is it giving a true and fair view? So we do believe the fact that we are permitting a choice in content of financial statements is an issue. There's massive talk at the moment about trust and transparency in Australia generally, but in the financial reporting space, and can entities trust what we're seeing in financial statements? Can they trust the audited financial statements? We're seeing lots of issues and lots of errors. So we think if we had a consistent framework and entities knew what they had to comply with, that we actually would help increase that trust and transparency and reduce the risks. Because if you are a director of an entity who is picking and choosing which accounting standards you're complying with and how you're putting together your numbers, we actually think that's a bit of a risk. We think it's a risk for auditors, but for you guys, you're more interested in the risk for the directors. So we actually believe that this current concept of being able to pick and choose what's in a set of financials is causing issues. Hence we've said, okay, we think we've got these two problems in Australia, so we're not going to come up with a new imaginative name for our reporting entity concept in Australia. We actually think it's time to get rid of it. So hence this is what our proposal is. So we have issued a consultation paper. It has a number of approaches that how we could do this. And that includes, one of the approaches is we just release the framework within the next 3 months within Australia for all entities. That means everybody would have to do general purpose accounts. Now we've said that we don't want to do that. We actually acknowledge that for a lot of entities this will increase the burden. So what we're looking at in our preferred approach is to do this in 2 phases. Phase 1 is a short-term phase that is likely to be months. So we're not talking years, we're talking months. Within the next probably 3 to 6 months, we will release the new conceptual framework in Australia, but we will limit its application to entities who are publicly, for-profit entities, who are publicly accountable under the definition, under the standards, which is that you are listed or that you are a financial institution, and any other entity who chooses IFRS compliance. So if you want to be IFRS compliant, absolutely you are able to use this new conceptual framework because you're already doing full Tier 1 general purpose financial statements. So we don't expect anything to change for you guys. There's some slight differences in the conceptual framework, but realistically it's not going to change anything for you. You still carry on doing your full Tier 1 general purpose. Then we have phase 2. Now we're saying that that's medium term. What do we mean by medium term? We're probably looking around about 2020, 2021. And we've said that we will then release the conceptual framework for all other entities who are required by legislation to prepare financial statements in accordance with Australian accounting standards or any other constituting document. So for example, if you are operating under a trust deed and that trust deed says you need to prepare financial statements in accordance with Australian accounting standards, you are captured by this definition. So we're not getting rid of special purpose for everybody. The mum and dad type organisations, to be honest, we don't really care what they do. They're deemed that they aren't a reporting entity, their financial statements don't go anywhere. What we're interested in is if you are required by legislation to prepare financial statements in accordance with accounting standards, or if something else tells you that you have to do that. For those entities, that's where we are looking to say they all have to be general purpose accounts. So who will this affect? It will affect anybody who lodges financial statements with a regulator, because that regulator in this legislation will say the accounts are in compliance with Australian accounting standards. So ASIC, our Corporations Act, says compliance with Australian accounting standards. Now arguably we should have always been doing this, because accounting standards are accounting standards, but because of this reporting entity concept, people have picked and choose which accounting standards they want to comply with. Anyone who lodges with the ACNC will be required to lodge general purpose financials or any other state regulator. Now that's obviously not an exhaustive list, they're just some of the main ones that come straight to mind when you think about legislators that require the lodgement of financial statements. In addition, anybody else, as I said, through a governing document, a trust deed, a constitution. Now you've obviously got time to amend them, and we know that that can happen. If your trust deed just said prepare financial statements, you aren't going to be locked into general purpose, because you effectively as the trustee would choose what financial statements are needed based on the needs of your members. But if the document says in compliance with Australian accounting standards, then you're locked into the general purpose accounts. The other areas that we want to think about are any entities who currently are lodging but are taking account of the non-consolidation exception, in inverted commas, in RG85. So RG85 is ASIC's guidance document that says if you are complying with the Corporations Act, you should do the requirements of this guide, which says full recognition and measurement, disclosure requirements of certain standards, but it does make a comment that consolidation is a presentation standard and therefore does not need to be complied with. So if you are in a group situation but are not consolidating, that will be a big issue for you because consolidation will be brought in. So these are the entities we're looking at. It's not for everybody. As I said, special purpose accounts will still exist, because if you genuinely aren't putting your accounts anywhere, well, do the accounts based on what your members, based on what the users want. If they want cash accounting, do cash accounting, because they're not going anywhere, they're not being lodged, they're not on the public record, there's nothing else telling you that you have to comply with accounting standards. But if you have to comply with accounting standards, it means general purpose going forward when this comes out. So what does general purpose look like? We know at the moment we've got 2 tiers of general purpose financial statements. Going forward, we're asking you what you think it should look like. So we have Tier 1, and we won't get rid of Tier 1. Tier 1 is our full IFRS compliance financial statements. Has to be done by all listed entities, has to be done by financial institutions, has to be done by certain elements of the public sector. Other entities can choose to do that. My recommendation would be, unless you have to, I absolutely wouldn't choose to ever do full Tier 1 accounts. So if you are doing general purpose, we currently have Tier 2 financial statements. So what we have at the moment is we have RDR, reduced disclosure requirements. Now that requires full recognition and measurement, so full compliance with all of the numbers. And what we do as a board is we go through every set of accounting standards, or every accounting standard, and we reduce those disclosures. So there is generally a disclosure, at least one disclosure from every accounting standard. We start off at the top level and we reduce it down. And that's where we sit at the moment. We have had huge take-up in RDR accounts from not-for-profits. We have not had a massive take-up in the for-profit sense. Part of me thinks that is because we see a lot more for-profits who do special purpose accounts, and they're not going to move to general purpose even though it's less disclosures. And that's partly because of consolidation and partly because of related parties. They're the ones that we hear the most we don't want to do, and hence we want to do special purpose accounts. So that's one option for Tier 2, is to keep what we've got. We're going through the RDR and actually looking to say, can we reduce it even more? But it would start off at that highest level and reduce down. The next option, which we have proposed in the consultation paper, is an alternative Tier 2. So we're calling it Specified Disclosure Requirements, an SDR. I don't love the name, but that's what we're calling it at this point in time. So what we're asking is, which would you prefer? We wouldn't do both, we're asking for preferences. So it will be full recognition and measurement, so we're not getting away from full recognition and measurement in Tier 2. It will be, excuse me, consolidation, so that is a given, you have to do that. It will be the disclosures required in RG85. So 101 is our presentation standard, 107 is our cash flow standard, 108 is accounting policies, 1054 is our additional Australian disclosures. So it will be those minimum, plus it will be all disclosures required in related parties, revenue, impairment and tax. I had a mental block about the last one. So we will not reduce any of those disclosures. You will pick up the disclosure requirements in those standards and comply with them. We are asking if there's any others we should include, but the way that it's written in the consultation paper, it would only be those 4 standards that you would pick up. And that is because that's what we've heard users want most information about. Even the ACNC is requiring more information on related parties, and they have required it in the AIS last year. They're going through a legislative review at the moment. They may require it in their legislation. So regardless of what we do in the standards, we may see that that's in there anyway. So they're the 4 standards we believe that are absolutely required to tell that story. They'd obviously be minimum level, so if you wanted to put more in, absolutely you can put more in to tell that story. So the difference between what we've currently got and what we were proposing in SDR is the first one is we start off with all the disclosures and we reduce down. The second one is we say you only have to comply with the disclosure requirements of these 4 standards, and that's it. So you would have the ability to not do any of the others. So they're the 2 alternatives that we are proposing, but the important message to get across is regardless of which one we land on, and we're looking for feedback on which to land on, it is full recognition and measurement and consolidation. So there is no get out for either of those. Then we've asked the question about Tier 3. Do we need a Tier 3? Now, anyone who's familiar with the New Zealand financial reporting framework, they have 7 tiers. We're now opening up and say, do we need a Tier 3? And if we do, who would that be for and what would it look like? So some of the feedback that we've heard is for the small not-for-profits who are lodging with the ACNC, would cash accounting be enough? And if we say cash accounting is enough, do we need to write an accounting standard that would assist them with the cash accounting? They have one in New Zealand, they have one in the UK. It's about a 15-page document, fairly plain English document, but at least to give them some framework around that. Or does that actually mean that certain not-for-profits, that will cause them some issues? So I'm the board secretary of a very small not-for-profit. We do cash accounting with a rent accrual at the end of the year. So if my cash accounting would prohibit my rent accrual, then I actually don't think that's giving the right view on my financials. So is a modified approach, a modified accruals approach, the best way to go? Or do we just not even need a Tier 3? So we're asking again for that feedback. If you think that we need one, who would it be for? And what should it include? What type of information within that? So we're not planning on going any further than 3 tiers, and it would just be for really small entities that we are looking to do that. So last week, last Monday, we released the consultation paper. It has a very long name, the IASB's Revised Conceptual Framework and Removal of Special Purpose Accounts. I think we actually changed it after I wrote this slide and changed the name and called it Solving the Special Purpose Problem, which I said I didn't like that name and wanted them to change it back because I said everyone will look at it and go, well, there isn't a problem with special purpose, so we're not going to look at the paper. It is a fairly long paper. It's about 70 pages because we're incapable of putting anything out that is much shorter than that. But if you look, I think there's about a 20-page executive summary or a 12-page executive summary. Just read that if that's all you want to read. There's lots of pictures in it to try and show this is what the difference would be. But please, 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 we need as many comments as possible on this. So we have put the paper out. We have actually split the comment period into 2. We've said that you have until the 9th of August to comment on phase 1. And the reason we initially were going to propose a 1-month comment period on that, we've actually pushed it out to 3 months because we've heard that there may be some publicly accountable entities who are preparing special purpose accounts. Now, as a board, we probably don't believe that should be happening under the existing standards, but if it is happening, we need to identify it, because we need to work out whether they're wrong and it's just, okay, you were wrong in the past, or whether our guidance is unclear. So we're given till the 9th of August to comment on that. That is, if you are publicly accountable and you are already preparing general purpose accounts, we issue this, we don't expect any change. We've given until the 9th of November for phase 2. So we've actually given a 6-month comment period on this. So we have asked in this particular paper, ignoring phase 1, because phase 2 is really where I think the bigger meatier issues are. Which do you prefer? Do you think there's any issues? Would you like any transition relief on consolidation? So one of the things we've talked about is to say, okay, let's say this came in 2022. I'm just picking a random date. Do we actually just let you leave your comparatives for 2021 the same, and you just do your consolidation as at 1st of July 2021? So do you need transition relief? Do you need any other relief going forward? Do you see any particular issues, and what would you like to see about a Tier 3 happening? So I'm now going to spend the rest of the time covering off our overview of these new standards and some transitional rules around it. I'm at the position that I'm spending pretty much most of my days at the moment talking about these new standards, and I feel like everybody says, yep, okay, we realise how many issues there are in these standards, we realise how much work there is to do in these standards, but we're not actually doing the next step and doing the action to get ready for these new standards. So what I'm going to try and do today is focus on some more practical type implications. If you have this, then it is an issue, and also give you some options for transition to try and get you thinking about practically how are we going to do this. So a reminder of the dates. 30 June 2018, there is no major new accounting standards coming in, so I'm not spending any time talking about new accounting standards today. There is a minor change for the cash flow statement, which is a reconciliation of financing activities. That's it. That's the only new change in standards that we've got. So effectively, 2018 is your time to say, let's get our existing accounting right, and let's actually think about our new standards. Then we've got 31 December 18, 30 June 19. This is where we start getting to see the big bang that is going to happen. Financial instruments kicks in for everybody. So AASB 9 is exactly the same effective date for for-profits and not-for-profits. Some not-for-profits I've been talking to think that because we delayed the revenue, that means we delayed everything else. We didn't. We have not affected we've not changed the effective date for not-for-profits for financial instruments. So AASB 9, for those of you in the room who are December year ends, we are currently getting to the end of May 2018. You should have been doing 5 months of AASB 9 accounting. For the Junes, it kicks in at 1st of July 2018. So you've got a month to get ready for this. The revenue standard, this kicks in for for-profit entities only. So this is the one standard we have changed the effective date for not-for-profits. So you get an extra year. The for-profits, this kicks in. So again, December year ends, we should have been into 5 months already of our AASB 15 accounting. These dates will not be pushed out any further. So if anyone is sat here thinking it's all right because we're going to push it out because everybody's so unprepared, we're not. There was a 3-year effective date, 3-year lead time for this standard and for the leasing standard. Revenue was pushed out once already. It's not going to be pushed out again. So that's where my real critical point is, I think, is the for-profits in the room for that revenue standard, because I just think the comment I made about qualifications at December, I genuinely think is going to happen. I think that entities are so unprepared for this, and the amount of work that has to be done is really quite significant. So that's our first wave. That's the 31 December 18, 30 June 2019. At December 19, 30 June 2020, this is where leases kicks in for everybody. So no change in the effective date for leases. That is exactly the same for for-profits and not-for-profits. The only one we've altered is revenue. So we can see that revenue for not-for-profits kicks in 31 December 19, 30 June 2020. When this standard, or when the leasing standard was first issued 2.5 years ago, I was making lots of comments for my for-profits, and I said to them, I want you to go with the big bang. I want you in this year to do all three. Revenue leases, financial instruments, get the whole lot done, get a transition program done, implement the whole lot. I'm now telling you that that can't be done unless you are already pretty much in revenue and you've already done all your implementation. I don't think you can do the big bang. I think you're going to have to do leases the following year because there's a massive, massive amount of work in leases as well. So let's just stick to the actual mandatory dates on that. So that's the time frame that we're looking at. We'll look at transition for each of the standards. That's our final closing balance sheet date. We've got to work that back, and we're looking at 1st of July 2019, which is just over a year away, and that's when the final standards kick in. So let's work through them. So if you have any financial assets, and I'm fairly confident that every single person in the room has financial assets, being cash, receivables, at an absolute minimum, that you are affected by classification changes. Now, it could be as simple as all you've got to do is go through and change all the terminology in your financial statements to get rid of your loans and receivables available for sale, held to maturity, and change it to the new categories, which are measured at amortised cost, fair value through OCI for debt instruments, fair value through OCI for equity instruments, and we keep fair value through P&L. It might be that if all you've got is cash and receivables and a few shares in listed entities, that it's as simple as that, but you don't know that until you've actually done the work. So at a minimum, all that terminology has to be changed. We have to reclassify. We have to make sure that our measurement basis is appropriate. If we have any equity instruments, now I'm not including subsidiaries, associates, JVs. What I'm including are a share in a listed entity, or it could be that you've got shares in an unlisted entity that are below significant influence. You bought them, it's not listed, so therefore you say you can't reliably measure it. There was an exemption under the old standard that says if it was a bit hard to get fair value, don't worry about it, just hold it at cost. And lots of entities did that. That exemption does not exist under AASB 9. That says it might be hard to get fair value, but figure out a way of doing it. Even if it's not completely reliable, you're using valuation models, you're using techniques, you're in that level 3, you still got to come up with fair value. And I'm seeing a lot of my clients have got these. So it could be that it's in there as a $2 share, could be a $500 share. We've always ignored it because it was immaterial, we've always just rolled the amount forward. I've got a client who's got 1 share in a radio station. There's only 8 shareholders in this radio station. They were holding it at $2 because that's what they paid way back when. It is an incredibly successful radio station, and that share is worth way more than $2. So they are now having to fair value that. It's a material impact on their financial statements to make that adjustment from cost to fair value. So have a look at your general ledger. Do you have any of these investments? Generally very, very small value because you bought them years ago and you just rolled it every year. How are you now going to get the fair value of that? Still on equity instruments, anyone who has got available for sale investments at the moment. So let's say I'm holding shares in Qantas and I'm holding them for long-term gain for dividend growth. It could be a not-for-profit as part of a managed investment type scheme that you're holding a number of shares. Anything that you're holding and available for sale at the moment, that category does not exist under AASB 9. You are still able to designate them as fair value through other comprehensive income. Arguably should have done it on day 1 of adoption of this standard, so 1st of January 18, 1st of July 18. You don't have to impairment test them anymore, so all movements in fair value go down in equity. Sounding quite attractive so far because you're not having your impairments through the P&L. And people are happy with that. What they're not necessarily happy with is if I sell those investments, any gain or loss that I make also stays in equity. It does not get recycled through the P&L. So even we've got realised gains that are staying down in an equity balance. So just be aware of that. If you've got any of these available for sale, you're going to have to look at it because there's going to be changes in the way that you account for that. You might make the decision to change on adoption, you can change your classifications. So you might decide that actually you're willing to take the risk of fair value through P&L in order to get final gains or losses through the P&L. So you have to make that decision. Anyone who's got loans, receivables and advances, again fairly confident that everybody in the room will have at least receivables. Our impairment provisioning has changed. So at the moment we have an incurred loss model, which means we have to have evidence that we have incurred a loss. We're moving to an expected loss model. So that means on day one, I have to consider what is the expected loss on this particular transaction. Now, according to the standard setters, they believe there will always be an expected loss because of credit risk. So as soon as you've got credit risk, potentially there's a loss there. In the banks, the financial institutions, they've come up with the most elaborate type models about doing this expected loss. What do I expect to receive? Those of you who are not in the financial institution space, how are we going to do this? We are expected to consider losses over either 12 months or the lifetime. As soon as it becomes more than 30 days overdue, then we're considered to have a significant increase in credit risk and we have to increase provisions again. We're looking at history with that particular debtor. We are also looking at going forward what's happening in the economy. If this particular client is operating in the oil and gas industry, well, that's not going overly well, and therefore potentially we've got an increase in the impairment of that bad debt. So we need to be thinking about how are we looking at expected losses on day one, not when the debt starts becoming old. Expected to be earlier recognition of bad debt provisions. There is a suspicion that we will see the return to general bad debt provisions. Because if you tell me what's your expected loss, your immediate answer is going to be, well, generally we write off about 0.8% of our debts, but that's my expected loss. In the outside the financial institution space, in my heart of hearts, that's probably what I think is going to happen. Is it in compliance with the accounting standards? Strictly no, but it's the best proxy that you're going to get, and I probably don't want you spending any more time and effort to think about this. So as long as you've got a model that's looked at history, and it also takes into account what we know about the future in the current climate, I think that's the best that we're going to get. So you will have to be changing the way you recognise bad debt provisions. If you have any derivatives, there is a new hedging model. So previously I have always very vehemently said do not do hedge accounting. It is far too complicated, and I think that unless you've got massive amounts of derivatives, it's too much effort. I still probably am saying that. However, the new model is much simpler than the old model. So in the old model where you had to do retrospective and prospective effectiveness testing, and you had to see whether the hedge was between 80 and 125 percent effective, you don't have to do any of that anymore, so it's been made easier. I still think it's too complicated. Those of you who do have a significant number of derivatives, it might be worth having a look at it. We have seen entities early adopt this standard because they did like this new model. There's also more risks that are able to be hedged. It has expanded the risks, it has expanded the hedging instruments around that. And finally, disclosures. If you have any financial instrument, which again you all do, the disclosure requirements have changed. I am currently in the process, I write the content for a software provider who does template accounts, model accounts. And so it's on my to-do list this year to update the disclosures for AASB 7 in relation to AASB 9 and AASB 15. And I thought I'd start on this one because it would be easier. I have spent a significant number of hours on this and I have not got anywhere because I'm going round in circles about all of these disclosures and the extra disclosures, and there's a massive number of disclosures on transition. So I want to get the message across to you. The work I am doing is generic, so it has to meet every single entity, whereas you only have to do your entity. But please don't forget the disclosures. There are a significant number of disclosures on transition. Going forward, hopefully the disclosures won't be so bad. It's just a matter of changing terminology. There isn't so many new disclosures added. It's more making sure that our terminology is consistent with AASB 9. So even if all you have is cash, receivables and payables, you will see that there are changes under this standard for you, and you need to be thinking about this. What are you going to do about that? I find that the transition rules in this standard are a little bit odd compared to what we're used to seeing. So it tells us that generally we apply AASB 108. AASB 108 says we always change the comparatives and make sure that we're comparing apples with apples and put it through at the opening balance sheet date. However, you are not required to restate comparatives for classification and measurement. You can only restate if you can do so without using the benefit of hindsight. Maybe being slightly cynical. However, I suspect that everyone will say, well, we can't do it, we'd have to use the benefit of hindsight if we did, and therefore we're not going to restate comparatives, because that's absolutely what I would do. So you are not required to restate your comparatives for AASB 9, which means that your opening balance date will be 1st of January 2018, 1st of July 2018. There is no need to restate comparatives unless you can do so without using the benefit of hindsight for your classification and measurement. So you are looking at, if you decide to move your available for sale to fair value through OCI, the designation date is 1st of January 2018, 1st of July 2018. So again, we're not doing the apples versus apples. You have to be very clear on the transition method you are using. And that's why we're having so many disclosure requirements on transition for this. So there's tables that require you to say where were they designated last year, where is everything designated this year, is there any changes? Effectively, it's a big full reconciliation at transition date, but at least you're not having to restate comparatives. So that's financial instruments. Let's move on to our revenue standard. So remember that in our revenue standard, we've changed the fundamental principle. We used to look before about transfer of risks and rewards. Now we're focused on transfer of control. Have I transferred control of something to my customer? Control can be transferred if you have both goods. So traditionally we think of, okay, I'm selling you goods, you've got control of it. But it also deems that if you are preparing a service or providing a service, control of that can be transferred as well. It also introduces this concept of performance obligation. And this is the first time we have to consider, can the customer benefit from whatever we are providing? So a performance obligation means that I've transferred something outside of my organisation and the customer can benefit from it. If the customer can't benefit from it, and we've talked before about upfront fees, I'm charging you an upfront one-off membership fee. Can you benefit from that? No, you can't. You can only benefit as and when you pay the annual joining fees or the annual subscription fees. So the customer has to be able to benefit from the thing in order for it to be a performance obligation. We can't recognise revenue unless we've got a performance obligation. So when you're looking at your contract, it's all about, can the customer benefit? Previously, we've never ever thought about the customer. It's all been, have we, as the seller, transferred our risks and rewards? So a few things for you to think about in relation to this one. So have you got any long-term projects or projects spanning more than one financial year? So your projects might only be 6 months long, but if you've got a year end in the middle of that, you have issues about estimation. Traditionally in the past, we have used percentage of completion for all long-term contracts. And if you had a long-term contract, you just used percentage of completion. There was no thinking about it, we just used it. Now there are hoops to jump through before you can use percentage of completion. So anybody in the room who is using percentage of completion will need to check that they can still use it under AASB 15, because it is not a given, and we are seeing a number of entities who are not able to spread their revenue. They cannot recognise revenue until the end of the contract. Now that is obviously a massive issue that entities need to be aware of if that is the case, because your whole revenue recognition pattern can change. Please don't assume that percentage of completion is available to you under this standard, because it may not be. If you offer any change of mind refunds, so this is where I buy something and I decide actually I don't need it anymore, there's nothing wrong with it, and I take it back to the shop and they give me a refund. They can then put the product back on the shelf and sell it again. Now why is that an issue? Because I have to recognise revenue based on the expected consideration. If I expect to have items returned to me, then my expected consideration is nil, and therefore I don't recognise revenue for that item. So if I offer these change of mind type revenues, I have to estimate how many of them I will get returned, and I do not recognise the revenue relating to those returned items. I reverse for any revenue that I've put through, and I recognise a return asset on the balance sheet, and I recognise a refund liability on the balance sheet. Now I don't like to talk about tax, and I know we've got someone talking about tax after me, but there is going to be tax implications wherever we put things on the balance sheet, because we end up with differences in deferred tax. So change of mind type refunds, even if our contract says we will not refund, if your customary business practice is that you will, you account for your customary business practice and not what your contract actually says. So you have to think about that. As finance people, do you know? Not necessarily. It depends on the people who are out there actually dealing with the customers and what deals do they do. Do you have any contracts that include variable consideration? And I've got some examples on there. If you've got anything, and the construction contract is the classic example when someone's building me a house and there is a rain delay clause in there. So they're meant to finish it by a certain date. There'll be a bit of a grace period in there, but then if it goes beyond a certain period, because it rained a lot, they have to pay me or the consideration gets reduced by that rain delay. My construction company, if they are able to spread their revenue, has to consider at day one, what do they think that contract value is going to be? What is the expected consideration? So if they're charging me $500,000 for the house, but they expect it to have to pay these delays to me, and therefore will only earn 480, it is 480 that they are spreading, not 500. We don't deal with the bonus, the incentive, the penalty at the end. We deal with it as we go if we can spread. So if you've got any of those contracts, and a lot of the contracts I look at have these variable clauses. It might be KPI indicators, it might be rebates, it might be price concessions, it might be bonuses, claims, etc. You have to work out how you are going to estimate the expected revenue. If you charge upfront fees as part of a contract, whether you call it a setup fee, a membership fee, an admin fee, an activation fee, a mobilisation fee, don't care what you call it. If you are charging an upfront fee and effectively the customer is not getting any benefit, it's just to set up the contract to get ready, you cannot recognise that revenue on day one. You are required to spread it over the life of the contract. This is causing all sorts of concern for people because that's what they're used to. They have the cash, they're sat on the cash, yet they can't recognise the revenue in relation to that. Now again, potential tax issues for that because we are then not recognising revenue even though we've got the cash. What do we do for the ATO? What do we do for our tax return? So any of these upfront fees, please start looking at these. And this we're seeing in the for-profit and the not-for-profit space. If you offer long-term financing arrangements, so I'm offering you a 3-year service and I will charge you $100 per month for that service, or you can pay for the 3 years in advance and you can pay me $3,000 up front. That means that the cash price equivalent for the 3 years service is $3,000. If you pay over instalments, you're paying me $3,600. $600 therefore is a financing component. It's interest revenue for me. So I still recognise the same amount of revenue, but I split it differently. So if you are offering any of those financing type activities, any of those buy now, pay later, take it home now, pay later, pay now and I'll give you the service over the years, potentially is an issue, significant financing component under AASB 15. If you make any payments to customers in the form of vouchers, incentive, loyalty programs, a number of you will probably regularly buy a cup of coffee most days, and a number of you will have your little cardboard cards and you get a stamp every time you buy a coffee, and after 8 coffees or 10 coffees or whatever it is, you get your free cup of coffee. That's an incentive that you are receiving. The $4 that you are paying for your cup of coffee is paying for your free cup of coffee, a portion of that. So it's a performance obligation, it is an incentive back to you, it is a loyalty program back to you. Let's assume our coffee shop was doing general purpose financial statements in accordance with 15. They would be not recognising $4 worth of revenue. On the day you buy that coffee, they might be recognising $3.70 or whatever it is, and accumulating that other one for when you want your free cup of coffee. Now that's obviously a very small example. Think Qantas with your frequent flyer points. Think anybody else who is giving back loyalty points, who is giving rebates, who is giving any other incentives back. Wherever we're offering any of those, it is an issue under AASB 15 because we have to look at what are our performance obligations, how much revenue should we be recognising in relation to that particular transaction. I would hate to think that all those incentives are stopped because of AASB 15 and it's a bit hard, but we do need to at least think about our accounting under them. If you have performance obligations in the contract which are not sold separately in the market, so you are offering to do a number of things for your clients and you bundle them all together as part of one package, but you actually don't offer those obligations separately, you have to consider how you're going to price them because you're charging one price from the contract, but those performance obligations might be satisfied on different dates. and therefore a price needs to be allocated to each of them to know how much revenue to be recognising when you are satisfying that performance obligation. So it's estimated cost plus an estimated margin. I said 5 words and 2 of them were estimated. So there's a lot of work in that guesswork about how we do that. We need to think about that. Potentially we can get the people who write our proposals, our tenders, to actually think about it, because they've got to cost all of our jobs. How do they cost it? They cost it using estimated costs and estimated margins. So if we can do that back in that costing phase, it might actually help with our AASB 15 stuff, rather than you trying to do it after the event. Customary business practices that vary from the terms in the contract. This is quite difficult for finance people to come up with, because we don't know what the salespeople are promising to do. We don't necessarily know what actually happens. So to give an example, I've done some work with a recruitment agent. And as you'd be aware, a recruitment agent contract is very clear that they will place somebody, and if that person does not work, you can return the person, and they will then find you somebody else, but they will not refund the commission. And I said to them, do you refund the commission? Yes, we do. For certain clients, we do. Most clients, we don't, but for some clients, we do, because we would rather keep them happy because of the amount of business we get from them. That's a customary business practice that overrides the terms in the contract. And I need to account for the fact that for that client, what's the probability that I'm going to refund that particular commission? What else do we offer? What is a goodwill practice within the industry that actually we throw in there? I bought a lawnmower not long ago and they threw in my free first service. Is that a substantial performance obligation to me? Do I need to hold that back? The contract didn't necessarily say that. That's just something that they throw in. Is it industry practice? A goodwill gesture? Do we understand what type of thing we're throwing in there in order to be able to account for it? Do we incur any costs to obtain a contract, or do we incur costs to fulfill a contract and we are having to defer the revenue or spread the revenue? So let's take the first one first. If my salesperson wins me a big contract, let's say they win me a 3-year contract, I pay them a sales commission. Currently I expense that sales commission as and when I pay it. Under this standard, if the contract is more than 12 months, I capitalise that sales commission. And I recognise it on the same basis as I recognise the revenue. Now that sounds quite attractive, because we say matching doesn't exist, but this sounds awfully like matching, where we're actually spreading that. But have you got the systems to be able to track that? So you need to think about what are those incremental costs that you pay because you've won a contract. Doesn't include things like a proposal cost. So you write a proposal and you incur those costs regardless of whether you win the contract or not. So that doesn't count. It's only a cost that you incurred because you won it. Cost to fulfill a contract. If I'm telling you you can't recognise revenue until you've completed a contract, I'm not making you expense all costs throughout the course of that contract. What you do is you capitalise those costs as a contract cost asset, recognise it at the same time. Tax implications, because I'm putting more assets onto my balance sheet. So the work that I have done, most industries that I have looked at have been affected by this particular standard. I used to give an example, and I used to say there's only one client I've worked on that hasn't, and that is a cemetery trust, and it was very specific, and everyone would laugh and go, "Ha, you haven't got a cemetery trust." In the last few weeks, I've been doing some work on a different cemetery trust in a different state, and they're impacted by AASB 15. So I can't now even say that my cemetery trusts are fine, because their terms and conditions varied, and they now have some big impacts under AASB 15 because of the different terms that they have. So it is very much client specific. It is based on your terms and conditions in your contract. There is a huge amount of work to get your answer under this, and even if you come out with nothing really has changed, there is a lot of work to get there. I have not covered disclosures under this standard because I wanted to go through this more. The disclosures under this standard are massive. So please, when you're looking at this, make sure that you are looking at the disclosure requirements. You need to be smart around your disclosures, because there are concerns by entities that these disclosures will give commercially sensitive information. If you are rushing the disclosures, you might end up disclosing something that actually you don't want to disclose. I think if you're smart and you think about it and think about your aggregation and your disaggregation, you won't disclose any commercially sensitive information, but you need to start looking at that. For not-for-profits, some additional areas that I think you'll need to consider. If you have peppercorn leases or any leases significantly below market value, that is an issue under this standard. You will be required to recognise revenue up front. Grant agreements for you guys, it is what's the grant agreement require? What actually do I have to do? Which leads into the next one, in which revenue standard am I in? So not-for-profits have two standards that they have to consider. Their first challenge is which standard am I in? They have very, very different accounting treatments. What I can end up with in the not-for-profit space is immediate recognition of revenue if I'm AASB 1058, or spreading of revenue or deferral of revenue recognition until the end if I'm in AASB 15. And also considering whether there are any other assets that you have received at significantly below their fair value. So slightly different issues for not-for-profits. However, a lot of those issues I've just talked about on the previous two slides are also relevant for not-for-profits as well. So transition under this particular standard. There are options. I, as a technical person, hate one of the options. However, given the timing where we're sitting, I actually don't think entities have got a choice. So the different options we've got is we do it properly. And properly is full retrospective, which means we change comparatives. We've got apples versus apples in our set of financial statements. I don't think entities can do this at this time unless they are already in 15 and happily plodding along and have nodded along to everything I've said here. Yeah, we've done this, we've done all the analysis, our general ledger is on this basis. Because if you were to restate comparatives, that means an opening balance sheet of 1st of January 2017 or 1st of July 2017. For December year ends, that's nearly 18 months ago. Entities aren't in a position to go back and restate that. The other end is the modified approach, and this is where I think we're going to end up with. So you do not restate comparatives. Your comparatives are exactly the same as what they were in the past. However, we need to have some comparability on a balance such as revenue. So what this standard requires you to do is to report in the current year, being 31 December 19 or 30 June 18, 31 December 18, 30 June 19, on what your numbers would have looked like under the old standards. So you are required to keep two sets of books in the 31 December 18, 30 June 19 financial year. That's for profits. Not for profits is 1 year later, because the only way we can get comparability is under the old standards. And that's what that requires you to do. So you're not restating comparatives, but you're carrying forward your old standards for 1 extra year. There are a number of practical expedients in this standard. Now, what is a practical expedient? It is something that the International Board put in there to try and make your life easier. So hopefully it means that there are less things that you have to restate. So there is a concept in there called completed contracts. For for-profits, you are only looking at the left-hand side. For not-for-profits, you are looking at the left-hand side and the right-hand side. So a completed contract under AASB 15 is where we have transferred all goods and services. We might not have recognised all the revenue, but we've transferred all goods and services. For the not-for-profits, it is either where you have transferred all goods and services or where you have recognised all of the revenue, because AASB 1004 required immediate revenue recognition for lots of entities. So if we have completed contracts, you can see that some of these practical expedients, and I'm not going to talk through all of them, but you don't need to restate some of them for completed contracts. There are only some of these that are able to be used if you do not restate comparatives. So you can see under number 2 and under number 3, I've said you can use them if you don't restate comparatives. Number 1 and 1A you cannot use unless you do full retrospective application. There is also a disclosure expedient. Can be used if you use full retrospective. I would probably say if you are able to use the expedients, you should use them because they have been put in there to make your life easier. And given the timing, I think anything that we can have to make our life easier under these standards is certainly worth looking at. By far, the most consistent message I'm hearing in relation to this standard is data collection. So how are we going to get the information to work out what leases we have? Because the definition of leases is slightly different from where we were in AASB 117. However, if you were to look at the definition in one of the old interpretations, it's probably not that different. But people ignore interpretations. So what we're finding is that there are lots more agreements that are actually being captured by the definition in AASB 16. They shouldn't necessarily be, but they are. It is things like if I'm using a pipeline and I'm using 90% of the capacity of that pipeline, I've probably got a usage agreement. I don't have a lease agreement, but I've probably got a lease over that pipeline. If I'm using IT outsourcing and I've got a server that I'm using 90% of the racks of that server, I probably have a lease over that server. Even though, again, I don't have a lease agreement, but an IT outsourcing agreement. So you will need to look at any agreement that is in place that involves the use of an asset and consider whether it meets the definition of a lease. We are seeing more and more of these agreements being captured by this. Once we've identified what we have as a lease, we then have to look and say, can we meet either of the exceptions? So the two exceptions relate to short-term leases, which is leases with a lease term of less than or equal to 12 months. Not seeing great excitement about this one, to be honest. I've heard people who've said they've got some speciality vehicles that they might only use for a short-term project, or if, for example, a senior member of staff has been brought in from interstate or intrastate and we've put them up in short-term accommodation for a few months. I'm not hearing a lot else about these short-term leases. People aren't jumping up and down and saying, yes, we've got all these and what a great exception. The one that they are getting more excited about is my low-value asset exemption. So this is where we have got, so only time we look at the value of the asset that we are leasing, and we look at the value of the asset when new. So regardless of whether I'm leasing a second-hand asset or a new asset, I look at the value of the asset when new. Basis for conclusions talks about a figure of around about $5,000 and that's what it means by low value. What I'm seeing in Australia is people are using round about $8,000 to $10,000 as their low value asset, and that's come up with because the standard says a vehicle will not be low value. So if we look at what is the cheapest new car we can buy in Australia, probably around about that $10,000 mark, and that's why people are looking round about that. It's not a bright line, but that's where people are looking. It will not cover things like photocopiers, because photocopiers, I've been told numerous times, cost more than cars, and therefore it won't cover that, but it should cover your laptops, your mobile phones, your chairs, your tables, etc., your water coolers. So that's another exception that we can use that people are finding is quite an attractive exemption. It is nothing to do with materiality. Any of you who have US reporting, that does not exist in the US equivalent to this standard. The US went materiality, the International Board have gone low value asset thresholds, and I don't believe they're the same answer, because under this exception, if I sign one lease for 5,000 laptops, could be very material. But because it's individual laptops, individual assets, I can still use that exception. So I could have very material leases that are kept off balance sheet using this exception. So just bear that in mind. It is optional, you don't have to. Whilst I don't particularly like them, because I think if you're going to have a principle, just stick with the principle, I also think it will make your life much easier, and therefore would recommend that you use them. So once we've identified what we have as a lease, whether we can use the exceptions, we then have to do our lease accounting. So from our balance sheet perspective, all leases are then on balance sheet. For lessees, we don't differentiate operating and finance leases. If you have a lease and it meets the definition of a lease, regardless of what you call it, it is brought on balance sheet. We have it as a right to use asset. The right to use asset follows the underlying asset, which means that in most instances I've assumed you're leasing a tangible asset and therefore I've shown it as tangible. We then have our lease liability. Now when we look at the basis of that, we look at the lease term. There's issues in this standard around lease terms. If I sign a lease that's a 5 + 5 + 5, what's my lease term? Is it 5, 10 or 15? Guidance in the standard is it reasonably certain I am going to take out an option? What does reasonably certain mean? You guys have got to come up with what reasonably certain means for you. Are you going to book a 5-year lease liability, a 10-year lease liability, or a 15-year lease liability? Very different numbers in materiality. So we bring on our right of use, we bring on our lease liability. My right of use is non-current, my lease liability is current and non-current. So those of you who have bank agreements should be thinking, is this going to cause me to breach a bank covenant? And the answer may well be yes, because you are bringing on a current liability without a current asset. From the P&L perspective, We've got interest, we've got depreciation, we don't have rent. We have potential impairment of our right of use, and we see the complication that if we have any variable lease payments that are linked to sales or usage, we recognise that as and when we incur it. So for the same leases, we could have depreciation, interest and variable lease expense. So that's my quick overview of leases again. What is a lease? We can't just look in our leases folder. We talk about, as auditors, a completeness assertion. If we want to know whether we are satisfying the completeness assertion, we don't pick up the folder called leases, we look at what else is not in there. And that's what you guys need to do. You need to look at all of the other agreements that you have got in place that could meet the definition of this lease. Lease term that we just talked about, what does reasonably certain mean to you? Can your existing systems capture this information? They've never had to in the past. They've never had to consider what happens if inflation increases and I need to recalculate my lease liability. Now they have to think about that. What happens if my assessment of reasonably certain changes and therefore my lease liabilities suddenly become longer? What happens if I modify my lease and suddenly I've changed my lease liability and my right of use asset? So they've never had to think about that because we've never recognised our operating lease commitments. So what are you going to do to make sure that that system is in place? Can you use either of the exceptions that I've just talked about? Do you want to use them? What policy have you got in place? If you use it once for short-term assets, you are locked in for using it for every other asset that you have in that class going forward that meets the definition of short-term. Your low value is on a lease-by-lease basis. Interest rates. We need to have an interest rate for our lease liability. So we need to know of every payment that we make, how much of it is interest, how much of it is principal. Do we have an interest rate implicit in our leases? For current operating leases, no we don't. I am hoping that as pressure is put on lessors, we will start seeing them. If not, we have to get our incremental borrowing rate. How do we do that? Do we constantly ring the bank and go, let's pretend I'm going to get a loan out today, what would you lend me the money at? Banks, I think, are going to get annoyed with that fairly soon. So how are we going to actually get our incremental borrowing rates if we can't get the interest rates implicit in the lease? We can't make them up. We have to have some sort of rationale for why we're using these particular interest rates. And what will be affected and how will we communicate to stakeholders? So from all of the standards that I've talked about, for those of you in the room who are listed, you need to think about continuous disclosure requirements. We are seeing a number of entities where adjustments have been made that have not been communicated to the market, and the market isn't coping very well. We'd like to think that all of our analysts understand these standards. They don't. So if you are doing your investigation and you realise that there is going to be material changes under these standards, we need to get that out to the market to let them know that this is the change, because they don't want to see surprises. And the more we can communicate that. Everybody else, we've got our standards issued not yet effective note. What are we actually putting in that? To be honest, they are dreadful, the quality of the standards issued not yet effective notes. The vast majority, and I'm talking over 95% of the ones I review, tell me that you have not yet assessed the impact. Now, for a December year end that's a for-profit, to tell me at the 31st of December 2018 that you have not, 17, that you have not yet assessed the impact of this standard when you should be accounting for it on the 1st of January is dreadful. We aren't seeing any enforcement around this. ASIC keep telling us to improve it, but they're not doing any enforcement. So please have a think about the June year ends that are coming up. What are you going to disclose in there about the impact of particularly the revenue standard? But leasing standard to me is a really easy disclosure in that you can say we currently have X amount of operating lease commitments notes. There may be some adjustments around this for short-term leases, for low value assets, for options, etc. But we are expecting the majority of these to come on balance sheet. They will be shown as current, non-current assets, current liabilities, etc. You can do some words without actually doing some, too much work around that. That's the type of thing we should be seeing, particularly for the leases. The revenue one, I agree, is harder because you have to do a lot more work to understand the impacts for you. And basically, why would anyone ever want to invest in them? That's it. I've paraphrased. So Retail Food Group came out and reacted to this and said, this is a standard that's applicable to everybody. Nothing has changed. Our cash commitments are identical. We still have the same lease agreements that we would have in place before this standard. But what it showed us was the market isn't understanding these standards, and the fact that an analyst actually put this report out. We've seen some other commentary from analysts about these new standards, that people need to be aware of it. But I've had discussions with them and they still don't fully understand what these standards are going to show us. So therefore, as listed entities, we have a responsibility to inform the market and inform shareholders. It would not surprise me if when these standards come out and the adjustments that are needed, we will see a raft of cases where they are shareholders are suing the entities. Because if the numbers are dramatically different, was I being given the full information that I needed to be able to invest in these entities, and would I still hold my shares, or would I have bought the shares had I known the impact of the numbers? So it really, listed entities is imperative for keeping the market informed. Everybody else, it's who do we think needs to be informed. And banks in particular, particularly with this leasing standard, you need to let them know if you think you're going to breach your covenants, so covenants can be rewritten. I did a presentation in Perth a few months ago, and I did it to, it was a bank, and then but it was with the bank's clients, and I had a few of the credit people from the bank in afterwards. And one of them came up to me and he said to me, "Why don't we know about this?" So I was like, "I don't know, why don't you know about it?" And he goes, "We work in credit. We're writing bank loan agreements for our clients every day with covenants in there. We are completely unaware that this standard is about to throw all of those covenants out the window. Why aren't we aware?" That's why. But it kind of scared me a bit, because I went, we're relying on these bankers to make sure that right covenants. I'm telling entities, talk to your banks to make sure if you're aware you're going to breach covenants. But we need to make sure we're having that communication, because you don't want to turn up once you've adopted this standard and going, actually, we've breached our covenants. Anyone who pays dividends, these are potentially issues as well, because if your revenue has dropped or your income has dropped because you've got more expenses under this standard, and you are paying out dividends when you don't meet the rules in the Corporations Act because you haven't calculated your impact, potentially there's a solvency issue in there as well. Just very quickly to go through the transition methods. We have the same transition options under this standard as we do under 15. However, they've made it harder to do the right thing, so therefore my strong recommendation is we do modified. We do not change comparatives at all. What we are required to do is to disclose the difference between our operating lease commitment note at the date before we adopt this standard to the lease liability on the day after we adopt this standard. The operating lease commitments note is not a note that gets a lot of attention. Please, for the next couple of financial reporting periods, give it some attention so you can actually give some good explanation on why there is a difference. And there will be a difference. There'll be a difference because of low value assets, there'll be a difference because of options, the way we treat inflation, etc. But you don't want one of the differences to be we stuffed up the operating lease commitments note and that's why we've got it wrong. So that's the disclosure you need to put in there. There are a number of practical expedients in this standard. These three on the first slide are available regardless of whether you restate or not. To me, the only one that is really of value is the first one. Now, this says that you are not required to consider whether you have a lease. However, I have just told you all that I want you to look beyond your leasing folder for completeness. This is not a reason to carry on bad accounting. This assumes that you looked at all your agreements in the past and assessed whether they contained a lease. If you did that and assessed they did not contain a lease, then you don't need to reassess on adoption. My suspicion is that most people did not even consider whether many of these management agreements, usage agreements, supply agreements, outsourcing agreements even considered a lease. So it's not to say if you did it wrong in the past, don't worry about it. It's if you did it correctly in the past, you are not required to reassess. So you still are required to reassess and make sure that you are doing it right at the moment. The next two slides show some practical expedients that you can only use if you do not restate comparatives. So this is why I said the International Board have made it hard to do the right thing and why I encourage you not to restate comparatives. If you have a lease that ends within 12 months of transition, so if you are transitioning for your June year end, you transition at 1st of July 19. Any lease that expires before 30 June 2020, you don't need to do anything under this standard. You can just keep going with your old operating lease. For the right of use at transition, you can force the right of use asset to be the same as your lease liability. So you are not therefore required to go back and recalculate what that should have been. You calculate the lease liability and you just do your debit and your credit exactly the same. You can use the same discount rate for similar leases on transition, so it saves you having to go back and work out what your incremental borrowing rate would have been, or to look at the interest rates implicit in the lease. If you have an onerous lease and you have recognised an onerous lease provision, so it could be that you are paying a certain amount of rent and you know that rents have plummeted nearby, but you're still locked into this contract, therefore you've recognised a provision. You are not required to do an impairment test on your right of use asset. You can just take that provision and offset it against the right of use asset on transition. If you decide to go back and do right of use calculation properly, I wouldn't recommend that you do, but if you do, rather than forcing right of use to be the same as lease liability, it does allow you to ignore your initial direct costs. Finance leases that Daryl's just mentioned, and I said on day one, you can choose to put all those balances to be the same, just transfer them into the relevant category. And you are able to use hindsight in relation to extension or termination options. You don't have to think, what would I have done back when I took out the lease? You can actually say what has happened. So that's why I strongly recommend not to restate comparatives, because I think these expedients will actually make your life much, much easier. So a few things to think about, and I've said on this slide, those in governance, what do they need to think about? Because we really need to make sure that this message is getting across, that it's much higher than just the finance team. So have we got any bonus schemes that are linked to revenue, that are linked to assets, that are linked to EBITDA? So we need to actually change that, because your employees are going to love you if you suddenly get a big bonus because EBIT has gone through the roof due to the adoption of this leasing standard. Entities probably not quite so excited about paying out a big bonus in that scenario. Talking to banks, shareholders, etc. We've talked about systems. I've mentioned dividends. This is crucial, because if you pay out a dividend when you are not supposed to, you have breached the Corporations Act, and to breach legislation is a fairly significant thing. Delegations policies for leases. In many organisations that I go to, every man and his dog can sign an operating lease. You do not want everyone signing operating leases going forward, because they are all on balance sheet. So please look at the delegations, please make sure that they are changed to be raised. You only want certain people signing these, probably the same as a finance lease, maybe the same as the value of the asset that they're signing up to. Continuous disclosure we've talked about. Earn-out clauses, I again think there's going to be massive issues in a few years in relation to that, because we're buying a business and we say that if EBITDA increases by X% in 3 years' time, we will pay you an additional consideration amount. Unless you specify that EBITDA changing has got nothing to do with this standard, you potentially are going to be paying out big amounts to former owners, not because the business has grown, but because you've changed the accounting standard. So we need to think about that if you are undergoing any business combinations. The lawyers, don't assume the lawyers know these standards, because they don't, and you've got to make sure that you are protecting yourself with the wording in those earn-out clauses. And finally, management accounts and budgets. I've talked 1st of July, I've talked 1st of January, but if you are going to implement these standards in your management accounts or budgets, your deadline is not the beginning of the reporting period. Your deadline is whenever you are starting to do your budgets. People aren't comfortable with differences between management accounts, budgets and statutory accounts, particularly when these numbers can be quite material. So you just need to think about what you're going to do about those. And the elephant in the room. Who is going to do this work? You guys aren't sat around saying, please let the Standards Board bring a new set of standards in that's going to create lots more work for us, because actually we don't have enough work to do and we could do with filling in our time. You're not. You're all incredibly busy people. So who is actually going to do this work, both on transition and going forward? And should it be finance? We need to make sure we're implementing people from all of the organisation who are going to be affected, whether it's facilities people, whether it's legal, whether it's IT. We need to be thinking about this resourcing sooner rather than later on this.
Just quickly, a few things to think about with those new standards, so feel free to talk to any of the HLB staff or Carmen after this session, or just get in touch with your contact at HLB. Next up is Joel. Joel's going to cover off some changes to tax in 2018.
James, thank you very much for that introduction, and also Carmen. I love getting to see these financial presentations. They don't normally let me out of the box long enough to actually see them all through and appreciate what changes to financial statements actually occur. But just to give you a brief summary of my take on the AASB 15 and 16 and the way it will interact with income tax. it's fairly simple. Most of the things you've heard today will back up for income tax purposes and do something quite different. And so where I see that will be a lot of friction coming out of that is so accounting for income taxes. So a lot of leases will remain as they are currently, treated as being an asset that you don't own or hold for income tax purposes. So I think that's where I'll see income tax and the way it doesn't mesh in at all with accounting standards for those affected entities and the long-suffering CFOs who have to implement these things. We'll go through quite a transition in terms of, well, first of all, how it is that tax will do something different, and then second of all, how that flows into your income tax accounting and tax basis. But now for something completely different. I wanted to run through 4 key areas today which might affect your organisation. Key tax changes for 2018. The first one, federal budget, top of mind, has received quite a lot of attention in the press for a range of different reasons. But then I'll also be touching on a little bit of transfer pricing, how much do you need, hopefully not too much. Typical traps that we see in practice in terms of superannuation guarantee. And also to talk a little bit about single touch payroll, some changes that are coming in here. I think today, if you're interested in financial reporting, it's quite likely that you'll be an organisation that has 20 or more employees, and therefore you'll be impacted by single touch payroll, which has mandatory effect from July. And so that's an important thing to keep in mind, and not just the system changes, but to think about where it is that the tax risks emerge in your organisation going into single touch payroll, how much more granular information the tax office and your employees will have available to them on a real-time basis. The thing I love about the budget is there's this huge tome of documents that get released at the time, and often what makes the headline issues is typically individual income taxes, and this budget, I suppose, has been no different. So just to touch on the obvious ones that we saw, the government's proposal was that we'd see essentially a 3-phase decrease in individual tax rates, principally for initially low to middle income earners, and then to see some income tax relief for those earners who are up to $180,000 and over $200,000. One thing I thought was sort of interesting to ponder about in all of this discussion, there's been a great deal of focus on that second aspect. It sort of makes the presumption that we might be seeing the same government in July 2024 as we do now, which I think is a pretty bold assumption at the moment, especially considering how the political tide's been going. So one thing that is immensely popular and probably is not entirely independent of the fact that we're sort of moving into election mode again, is that there's been a notable extension of the small business $20,000 instant asset write-off to 30 June 2019. And that's, of course, been immensely popular with a lot of small businesses and small business owners. Just to bear in mind that $20,000 is actually GST inclusive, so you've got to be a little bit careful with going out and buying assets between now and 13 months' time, if you're in that category. There has been a very substantial, or proposed to be a very substantial, overhaul in relation to research and development. And those changes to research and development will affect both. So there's sort of 2 different applicants for research and development at the moment. There's the under 20 million people who can typically cash in or get a refund for their eligible R&D expenditure. They'll be affected by that last dot point there by having their cash refunds capped at $4 million. The other type of R&D applicant that we see a lot of is for those entities and groups that have turnover of in excess of $20 million, and they are not eligible for cash refunds on their R&D spend, but get an increased tax deduction in effect. It works as a tax offset, but it sort of increases the value of your expenditure from a deduction sense. So that is proposed to change by virtue of this introduction of a new idea of R&D intensity, which is a little bit elusive. You can't quite work out what it means, but essentially what it means is R&D intensity is what is your R&D expenditure for the year, and compare that to your overall expenditure for the year. Now, if your R&D spend is more than 10% of your overall spend, then you're in that top category of getting 12.5%. But for a lot of multinationals or much larger organisations, you might be dealing with R&D intensity of only, say, 2%. So in those cases, you might find that your actual incremental benefit from R&D is probably going to be about a third of what it is currently. So who will benefit from these changes? Those entities that take on an awful lot of R&D expenditure. Who will get much less benefit? Those entities who are relative to their overall expenditure actually spending not too much on R&D. Now I'll get to talking a little bit about transfer pricing in a while, but certainly significant global entity and what it means for a lot of taxpayers has been the focus of a lot of attention over the last year or so. Why do you care? Because once you're into this regime of a significant global entity, there's sort of a couple of different aspects. If you are a significant global entity, then you're supposed to prepare and lodge with the tax office, if you don't already with ASIC, general purpose financial statement. And that can, in this case, so that there's sort of a disclosure aspect. If you're part of a significant global entity, you've also got a significant disclosure regime. If you're a multinational, you have these 3 different reports which are required to be prepared and lodged within a year of your balance date. But the other thing to be really careful of is in a straight-out tax compliance sense. So your significant global entity is on an economic basis. It looks at your financial statements and says, when you consolidate everything together, do you have $1 billion or more turnover? And if you are one of those entities, or you're controlled or within a group that is a significant global entity, then the implication is that horrifying fine figure up there. Any statement that you lodge with the ATO, which is late, is notionally subject to that penalty up there of $105,000. And that can be your FBT return, your BAS return, failing to lodge on time in relation to your employer obligations, failing to lodge on time in relation to your CVC obligations, just about anything. Now those penalties are not currently being applied, but the transitional period will probably run out at some stage, and we will see some taxpayers having the embarrassing situation of having to explain why it is that they had a $100,000 penalty for lodging a couple of days late for any tax statement. So what's changed in SGE land? There was a little bit of confusion at the outset as to whether or not this last category that has been outlined in the budget, that is trusts, partnerships and private companies, should actually have to be treated as significant global entities and also investment entities. So, for example, funds. And so where I think this might get really the pointy end of the stick here is you will have, in some cases, entities that are controlled by some kind of non-corporate there, and therefore will be having to think about being an SGE, think about providing the tax office with their general purpose financial statements. And so that might be a situation where the income tax tail is kind of driving your financial reporting dog. Now, ThinCap's one of those things I find 80% of my clients just happily never really have to think about ThinCap, but for those 20% who do, it can be a really significant headache, and it's a really big issue because how you get into ThinCap, usually it's by virtue of having $2 million or more in debt deductions. Now, what will be interesting, sort of coming back to Carmen's presentation, is if you've got a whole bunch of notional interest which appears on your accounting statements, that might be interest for financial reporting statements only. It might not be what we call debt deductions for tax. It might not be affected by ThinCap. So another one of those interactions where life's just going to get more interesting for their both. So what was the announcement we saw in the budget? Well, it looked relatively innocuous. It just says all entities who want to apply the safe harbour approach, that is, you're trying to work out whether or not you've got more than 1.5 to 1 levels of debt, will have to apply their financial statements basis in determining what their assets and liabilities are. That sounds pretty innocuous, doesn't it? What's contentious about this? When the ThinCap provisions were introduced, there was also a provision in there to, rather than just straight out applying your accounting standards, to be able to apply in some cases a valuation, which is not the one used for financial reporting purposes. And what does this get at? Well, to the extent that you've got two identical entities, one which has undertaken a market transaction, picked up an entity, has started to recognise some kind of intangible on its balance sheet, that intangible has an identifiable value. Some other entities will develop their intangibles on an internal basis and won't meet the relevant criteria for recognition. And so you can have two economically identical entities which have different financial reporting treatments. And in a lot of cases, taxpayers who, as the levels of debt which you can actually accommodate within the Australian operating environment have come down, have started to look a lot more closely at these thin cap only provisions which will allow you to adopt a different value than the one you have in your financial statement. Why I think this is really significant is that that concession, which was basically designed to give a comparability of treatment for economically identical entities, is saying, well, no, you're going to actually have to apply your financial statements basis in working out what your assets are. So if you can't or don't recognise intangibles for your financial statements, you also won't be able to take them into account for thin cap purposes under the safe harbour method. So question again, is this another case where we might see that results in people doing different types of things in relation to their financial statements disclosures in the future? This was sort of an interesting one that we saw come up, and it's more, I suppose, targeted to non-business holding of land. What is it? It's a proposed denial of deductions in relation to the holding of vacant land, which can affect both commercial and residential land. It will not apply to land which is applied to some form of an active business. So primary production businesses, not affected. Similarly, active development businesses should not be affected. But what will be affected is where you have a situation where, for whatever reason, you are accumulating land with a view to, at some stage, conducting some future business. And in those cases, you might have started to deduct, for example, your interest or your land tax rates or those similar type of ongoing expenses. And there's a sort of a strong policy driver here, which is basically to try and reduce the extent to which land is being banked, or to free up more of the supply for land and residential development. So you also can switch off these provisions or the denial of deductions by actually completing construction on the land. So it puts you in a different category in relation to vacant land as against land that someone's been constructed on. This is another one of those slightly frightening motherhood type statements related as part of Morrison's agenda. Tax officers to receive $134 million to assist in the tax officer's debt collection. I think the collection of tax debt, which is due and payable, can only be a good thing, but running the metrics here, what's announced in this budget is that they anticipate over a 4-year horizon that the investment of $134 million of debt will yield to $1.6 million more in collections. And that's a sort of a fairly familiar metric that I do see coming out as you put $10 into active compliance or collection, and you get $100 worth of basic collection in increased revenue. And why is that relevant for us? Well, if you spread that over relatively few debt cases within Australia, you can sort of see where the bouncing ball is leading in this case. I feel that we will see it a lot harder in the future to get payment arrangements, or we'll see a fair bit more firm action in relation to any taxpayers or organisations in particular who aren't able to pay their tax as and when it's due. This one didn't get a lot of attention, but I find it's really quite an interesting development. So what was proposed in this budget was an outright denial of deductions in 2 different scenarios. It's actually come under the heading of the black economy agenda. So what does it affect? It affects a situation in which pay-as-you-go withholdings or superannuation needs to be withheld and has not been done. And what it will do then is for those cases where those withholdings have not been made, it will actually deny a tax deduction for those amounts. So what you can see there is that, for example, if you're on that sort of penumbrum between employment and a contractor status, and that's determined not by the form of the contract, but by the economic substance of what it is that you do in relation to your contractor/employee. So if you get that decision wrong in terms of your how it is that you arrange contractors or employees, a potential outcome of that is you actually completely lose the tax deductions for all of those costs that are incurred in somebody who you might have thought was a contractor, but at common law is found to be an employee. To add to that, of course, if you don't withhold pay-as-you-go withholding in super, that can become a personal liability of directors. So you can see there that there's a sort of a strong driver there to collect pay-as-you-go withholding in super very quickly. There's a great deal of risk now attached to engaging, in particular, individuals on a recurring basis in a way which looks a little bit like what you might do with an employee. Also, there'll be a denial of deductions where you might have cases where you don't have a valid ABN for some reason. Now, technically speaking, if you don't receive a valid tax invoice and you don't do one of those subcontractor no ABN withholding forms. That should be subject to 47% withholding, and you should give them a statement at year end. So what this is doing here is saying, if you don't have the ABN or you don't get a valid tax invoice and you don't withhold, then you're also going to be denied the deduction for the amount that you would have had you under ordinary circumstances. Currently, the building and contracting industry is subject to this special reporting regime under which they have to report basically all payments made to contractors within a given income year. It's quite onerous. You have to provide one of these every August. And so if you're within that industry currently, you'll be familiar with those reporting obligations. So what was proposed in the current budget is actually the tax office loves this extra granular information that they get on contractors and subcontractors in particular, so much that in fact the Treasurer proposed to extend this to 3 new categories starting on 1st of July 2019. So if you are involved in any way within those 3 industries, you might find it's fairly important to watch out for changes and also get ready for the prospect that you're going to have to report all of your contractor amounts in the future. Another thing that will come out of this quite frequently is if you start reporting all of your contractors, given the statements I've just made about how the tax office is pursuing the contractor/employee distinction quite carefully, you want to make really sure that by the time you're in these industries, that you've assessed that all of those contractors there are not in a situation where perhaps you really should be withholding and remitting pay-as-you-go withholding in the way that you would for an employee. So those 3 categories: security providers, road freight, and computer system design and related. And every time I see something like and related, I sort of get this nervous twitch where I think, oh, how broad is this going to go? Another sleeper here that certainly as a director makes me not sleep at night, an extension of the director penalties regime. I mean, we're probably all familiar here with the fact that unpaid pay-as-you-go withholding and super guarantee, if it remains in that way, automatically leads to a personal liability of directors. Now, didn't get a lot of prominence, but it's now proposed as part of this anti-phoenixing agenda that's part of the budget, was that personal liability could be extended to GST, luxury car tax and wine equalisation tax. The prospect of being subject to personal liability as a director for unpaid GST is a little frightening. So to my mind that means you've got to get ready for and make sure that your GST systems, often they're automated, often your systems will spit out a VAS number that you have to pay every time. Directors might not have a great deal of oversight about those systems and also the reporting of GST obligations as they come out. But if that has a personal if there's a personal consequence to not having those systems apply and work effectively, then it's going to be very much at the forefront of directors' thinking in the future, I'd say. I thought I'd touch a little bit this morning on what kind of documentation you actually need for transfer pricing. Now, hopefully, there'll be a lot of you who don't need any at all, and that's a situation we'd like to get to. But what we have seen in this area is, I suppose, in the last couple of years, certainly a stratification of some taxpayers who definitely need it all the time, some taxpayers who can use some pretty effective compliance measures to do something that isn't the full-blown transfer pricing, expensive documentation type of scenario, and then there's a whole range of taxpayers in between. A quick 101 on transfer pricing. Now, hopefully, most of you won't have transfer pricing considerations stuck in your door, so I thought I'd just quick summary of what it is. So, transfer pricing documentation gives a basis for, or it critically evaluates, if you've got a dealing with a related party, whether or not that dealing is the same on the same terms and on the same basis as you would do if you're dealing entirely independent. So it doesn't include anything like invoices or agreements or contracts or formulae or anything like that. None of those things comprise transfer pricing documentation because there's no critical evaluation and it doesn't look at what arm's length parties might have done. So this is sometimes referred to as the arm's length principle. Transfer pricing documentation, when the tax office comes to ask you whether or not you are in compliance with this arm's length principle, what is the basis for the position that you have? How are you going to show them that the price you charged is the one independent parties would have charged? And it's really, documentation is the show how aspect, and that is the really key thing to take away from this. You have to show how it was the right price that was charged, not just that what the price was charged. First question, when I sort of get to how much transfer pricing documentation do you actually need? First of all, do you have significant volume of international related party dealings? And significant can be, just in the context of your business, is it a large volume? either in an absolute sense and also in terms of how important it is for your business to get some kind of supply from a party who's related to you and is not in Australia. Now, happily, Australia is one of the few jurisdictions that doesn't have domestic transfer pricing issues. So if you're just dealing with domestic related parties, happy days, you're not going to need transfer pricing for these purposes. Working out how much documentation you might need for transfer pricing really is about asking that question, whether or not your international related party dealings, four-letter acronym there, just international related party dealings is a bit of a mouthful to have to get through. Are they significant in the overall context of your business? And I suppose the second thing to think about there is not all international related party dealings are created equal in the sense of, do you really need to think long and hard about it? And how do I distinguish between those ones? Well, there are some international related party dealings that are inherently hard to value and therefore inherently risky from a transfer pricing perspective. To the extent your business relies on unique intangibles that only you and your organisation hold and can apply, and you don't apply it anywhere else in the market because, hey, it's ours, why would we ever do that? Then that makes it really, that can be the type of international related party that's really hard to benchmark. It's really hard to get effective risk management around. But at the other end of the spectrum, I do have a lot of clients who, yes, transfer pricing is really important to us, but the type of things that we do are more like loans. We're significantly debt funded. But if it's a sort of a commodity type service, loans, to an extent, you can benchmark these type of supplies and get to a risk management solution that doesn't mean you have to go through significant cost and time to work out and manage your risk. The last thing is, if you are part of an SGE, you've got this massive disclosure every year on a global basis and on a local basis. You're telling the tax office a great deal on a granular basis about what kind of international related party dealings you have. And if you're in that category, I kind of think it's not legislatively mandatory, but I kind of think it's de facto mandatory that you should have some form of transfer pricing documentation. Question I do get a lot: is it ever appropriate to not have transfer pricing documentation? Happily, I can answer this, yes. There are a lot of cases where you evaluated what your risks are and you feel that you can manage them outside the process, or you've evaluated your risk to be relatively low. It may be appropriate to not have transfer pricing documentation, but not for SGEs, let's say. So, happily, the tax office has actually been releasing a number of different documents recently which assist taxpayers in doing something other than a full-blown transfer pricing documentation report. So the ones I've put down there at the bottom, if free takeaways, is there's a lot of taxpayers will fall into simplified transfer pricing, where within certain safe harbour criteria, you don't need to do the full valuation of the arm's length principle. Similarly, I was at a conference recently with the tax office in Cairns, and they have a team who's devoted to helping you manage and effectively colour code the level of risk which is attached to your international loans. And they are actually keen as mustard to get more people to participate in that. And if you have a risk, you can get out of your red zone and towards your green and blue zone. They'll help you do it. And essentially mean that you can get from a situation where you can self-assess how much risk have I got. Am I in the red zone? Am I in the yellow zone? Look at your loan terms. And then if you've got a problem, you can either change those loan terms with your related parties, or if you think you've still got a risk, you go cap in hand to the commissioner and say, hey, here it is, what do you think? And in a lot of cases, if you're dealing with really material values of loans and you've got a substantial enterprise, it would be much better to get on the front foot. So, and that will often be a lot better than, because you're really addressing your key stakeholder front on rather than seeking to do it through TP documentation, which is not engaging your key stakeholder in a lot of cases. So I've touched on the other aspect of SGEs. If you do fall into that category, being part of a group which has global turnover more than $1 billion, then the key points to note there is that you've got these three different things that have to be lodged. Absolutely mandatory. Tax office is now saying to call taxpayers and say, hey, you were supposed to have lodged this on the 31st of December 2017, but for the 2016 year, you haven't done it. You could be subject to fines. Make sure you do it. Some global entities, because so say if you've got an inbound investor, these two here, the CVC report and the master file, they have to happen at the overseas level. Now, in a lot of cases, there's sort of differing regimes that have adopted the SGE legislation differently. In some jurisdictions, these two aspects here are actually reported automatically by for example, the foreign parent automatically exchanged with the ATO, and then the local entity doesn't need to lodge them. But if there isn't that type of implementation in place, we sometimes find that in order to comply with the ATO obligations, the local entity actually has to file all three of these reports separately. So it's important to be aware that those obligations exist and not to disregard them, because again, $105,000 up to a maximum of $525,000 if you're more than 5 months late. For any one statement, 3 different statements, $1.5 million. So I can see a lot of boards not being terribly happy about that kind of penalty arising. Last point today, super guarantee caps. So I just thought I'd run through super. Now, in concert with the changes to single touch payroll, I think superannuation guarantee and compliance with it will become immensely more important. Sometimes super is really easy, it's just 9.5%. Sometimes it's that easy. I do think that contractors in the future will become a significant risk area. So it's quite easy to fail to pay 9.5% in relation to a particular quarter, either through a timing issue or an onboarding issue or some other reason. But that will typically be something where you can correct it over a period of time. You might miss out on some tax deductions. You might have to file an SG form if you're particularly late. But one thing I think is a huge risk area is contractors. Just because any contracts that you have are formed to try and indicate that the person supplying whatever it is not an employee and is a contractor, will not effectively preclude the pay-as-you-go withholding and super obligations from applying. And they, of course, if unpaid, remain a personal liability of directors. And if that runs on for a long period of time, if you've got a lot of contractors and it runs over a long period of time, then you've got a really significant risk to your business and a really significant risk there flows on also to directors. One thing that I do see as being very tricky to try and get right is 9.5% of what? So say you've got salary packaging in place or you've got fluctuating incomes, often it's very difficult to actually get your systems in place so that you're ready to pay the right amount of super at the right times. Another area where we see a bit of an issue is often in your organisation you might be trying to get your super remittances in quickly within June to try and make sure you get deductions for it, but the payment of an amount in June or July can have huge impacts on employees. So if for any reason the amounts are remitted to the super fund, for example in June where the employee might have expected to be in July or paid, that might suddenly, the employee might face excess contribution taxes. And there's really no effective way around that. So you've got both a bad news story and you've got a situation where your employees are going to be dissatisfied where they're trying to save for their retirement, but guess what? They've lost 47% of the extra contribution for that year just because of getting this June-July payment issue wrong. Last one is everyone here should now be applying the super stream method if you're not. So that's electronic payment of superannuation, but that's not all. It has to be electronic remittance advices that are through a complying super stream product. Now another last thing here with super guarantee is I'm going to talk a little bit about single touch payroll, and I think the implementation of single touch payroll I can see being a huge risk area for employers in the future because the tax office is going to have much more real-time information and it's going to be much more granular information. So they will know on every particular pay period as a result of single touch payroll how much an employee was paid, what the pay-as-you-go withholdings were, and what the superannuation remittances should be. And because they have all that information, if you're not, for whatever reason, paying the 9.5% in that period, you know that you're going to be much more quickly identified as a target for an audit. So actual risk of additional tax payable, but additional risk of just higher likelihood of audit is so much easier to identify. Single touch payroll applies for 20 or more employees. It's not a full-time equivalent basis, important to note. So if you've got a head count of 20, that will put you in single touch payroll from the 1st of July. You're supposed to have done your head count on the 1st of April to work out whether or not you're in the system. So unfortunately, if you get to 1 July and say, oops, I didn't see it coming, well, the tax officer's view is you should have counted it 3 months ago. So it's here. For everyone else who's not in that first category of 20 or more employees, it will apply from the 1st of July 2019. It's also got an associate inclusive one. So if you've got employees somewhere else within your corporate group, you put them all in together when you're working out, am I over or under the 20 employees, not full-time employees. Now, what is involved? You have to get single touch payroll compliant software, and what that will do as a simple takeaway of single touch payroll is, as I've said, the tax office will be alerted to the amounts of gross remuneration, pay-as-you-go withholding and superannuation for each reporting period for each employee Not only that, it will then flow through to the MyGov website and be available for employees. So you can sort of see a lot of the time the tax office didn't do a great deal about auditing SG because they relied on employees to actually tweak to the fact that their super remittances were not being done. But certainly, once this all becomes highly visible through the MyGov website to employees, you'll have both the tax office and employees having a great deal more visibility over whether or not you're withholding the right amounts of withholdings and making your super payments on time. Simple thing, make sure your software provider is actually ready to give you a solution for Single Touch Payroll. You can start reporting now, but you certainly will have to start reporting through Single Touch Payroll from the 1st of July. So what will happen in the future is once you go into Single Touch Payroll, rather than completing all of those pay-as-you-go withholding and gross remuneration type boxes on your activity statements, if you're in the less than $1 million category, will actually be pre-populated, so you won't be able to fill it in on the VAS anymore. It's all what's come through the software. You do have an option to actually pay immediately at the time that you have the withholding. I just can't see for cash flow reasons an awful lot of employers taking up that opportunity. So you're still able to actually pay the amounts of withholding at the same time as you do now through the VAS, but you can choose to pay at the same time as you provide the Single Touch Payroll reporting. And that was the entirety of what I wanted to bring up for you for tax for 2018.
Thank you very much, Joel. Thank you for your time this morning, everybody. We've given you a lot of information this morning, and as with these briefings, our aim is to let you know enough so you've got to make a decision as to what to do, and you know what you've got to make decisions about. I really encourage people to respond to the consultation paper that Carmen talked about, because the AASB, this is not one of those worldwide things that we can't change. This is an Australian-only thing, and Carmen has said the AASB wants to hear what people want. So you will make a difference if you respond to that. On the revenue standard, as Carmen said, you've got to assess whether or not how you comply with the new revenue standard. That doesn't mean you have a look at it and think, okay, nothing's going to change here. Strongly encourage you to sit down and document the 5 steps in the revenue process that Carmen's talked about before, and how each of your revenue streams fits in with those. So there's some work for you to do there, and you can do that now. For the not-for-profits, we've got an extra year, but we're getting Carmen to come back and give another briefing for our not-for-profits later this year in November. And the leases thing. We've got a lot of lawyers and banks out there, as Carmen said, thinking it's not a problem. Some loan agreements say do your accounts in accordance with Australian accounting standards at the time the agreement with the bank was entered into. Now, if that's the case, then you're going to have to keep 3 sets of books. One for the bank, one for the tax man, and another one for accounting. So you better have a look and see if that's the case and see what you can do about that. And on the tax, there's lots of things Joel's talked to you about there. The Single Touch Payroll, you should certainly be on top of that by now, because 1st of July is only 6 weeks away. So hopefully you're all on top of that. But if you need any advice, please talk to your HLB people. Please join me in thanking Carmen and Joel for their presentations this morning. Thank you for coming, and we'll see you at the next briefing.